So it's important. So there is no collateral. Okay, it is from 1 day to 14 days. Interbanking lending and borrowing. Okay, who participates and what is the purpose? Next, there is something called as call money market. Call money market. So whenever there is a liquidity mismatch within the banking system, okay, to address that, the banks can go to a market called as call money market. So basically, what is this? This is interbanking lending and borrowing. So one bank which has got more money on a particular day will go to the call money market as a lender. On the other hand, a bank which has got shortage of money on that particular day will go to the call money market as borrowers. So it helps to facilitate interbanking, borrowing and lending. So this is called as call money market. Okay, so the market where overnight borrowing, okay, 1 day to up to 14 days. So what is the period? You can borrow up to from 1 day to 14 days. 1 day borrowing is called as money at call, and up to 14 days, which is called as short notice money. Okay, just the terms. These are all can be asked in the exam. Okay, in a way to meet the liquidity. So on that particular day, a bank might have more withdrawal than deposit. It requires money. So that time it will go to the call money market. So to meet their reserve requirement or to meet their shortfall, okay, in cash. Duration is 1 day to 14 days. Okay. What is the interest rate that is charged? That is called as call money rate. Call money rate. And who decides this? It is not decided by anybody. It is decided, it is by the market forces, depending upon the demand and supply. Is that understood? So it is based on demand and supply. On a particular day, if there is more demand for money, the call money rate is going to be higher. If on a particular day, the demand for money is less, the call money rate is less. You understood? So it's like an interest rate only, which is decided by the market forces. It is a very good indicator of liquidity in the market. If the call money rates are high, that means liquidity in the market is less. If the call money rate is low, that means the liquidity in the market is high. So this is what is known as call money market. So usually the banks participate as both lenders and borrowers. Okay, so let's say ICICI Bank has shortage of money, it can go there as borrower. If HDFC has more money, they will go there as lenders. So both banks as well as cooperative societies, etc., they can go as both borrowers and lenders. Whereas other financial institutions like LIC, okay, insurance companies and all those NABARD, DFIs, basically, okay, and NBFCs, they can also go participate in the call money, but only as lenders, not as borrowers. Did you all understand? Okay, and here the borrowing is done without collateral. There is no need for any collateral that you have to give. See, just relate this with the repo market. In repo market, what happens? The banks go there to borrow money from RBI, but the problem there is what? You have to give collateral. Here, no collateral. So if the banks have collaterals, they will go to repo market and the interest rate is generally lower compared to the call money market. Is that all? Is that understood? So it's important. So there is no collateral. Okay, it is from 1 day to 14 days. Interbanking lending and borrowing. Okay, who participates and what is the purpose? Okay, answer this. Yes, all of you. One only. Collaterals are not required.